the WIP and deferred revenue management in OpenAir, and I'm going to touch on revenue containers. If you're not familiar with that feature, it's a whole separate feature in the system to help you with accruals and deferrals tracking. Okay. Now, if you're not familiar with what WIP and deferred are, you're most likely working in you're not in the finance area. You're working in operations, but WIP and deferred are really a way to understand how much have you invoiced a customer versus how much have you as a company earned revenue-wise or money-wise based on the services that you're delivering. So OpenAir actually does WIP and deferred revenue reporting, but it requires you to actually use both the invoicing and the revenue parts of the system. And OpenAir does very simple WIP and deferred math. If your revenue amount is more than what you've invoiced, you're in WIP because you've taken more revenue than you've invoiced the customer. And the reverse is if you've invoiced the customer but you haven't taken revenue, that is deferred revenue. And in both of these equations, if you're in a invoicing is greater than revenue, you're reporting on deferred but your WIP is 0, and vice versa. So OpenAir is smart enough to know WIP, there's no negative WIP in OpenAir or negative deferred revenue. It actually flips to the other reporting value. Now, there's a lot of scenarios related to like how you can actually end up getting WIP and deferred. So I kind of defaulted this webinar to focus on all the different types of contracts that I've seen customers have to deal with and how that WIP and deferred balance comes out and what are the trade-offs and how you set up the different rules to support billing and revenue recognition. So we're going to go through payments and deposits, like how that tends to be an upfront billing activity, and then how you're earning the revenue as services are delivered. There's also a unique twist to that with managed services where you may have sort of a regular billing cycle, monthly or quarterly with an hours allotment. And then there's also the a fixed payment schedule where you're basically committing to the customer that you'll just keep the payment the same month after month even though it's a T&M contract, and you'll true up at the end. And then there's also the annual subscription approach and then the fixed fee and percent complete. And last week's webinar focused on how percent complete can get calculated, so I'm not going to go into too much detail on that last one. We have a whole another webinar for your listening and pleasure related to that topic. So let's dive in because I have a lot of information to cover, and I may go through it a little quicker than you'd like, but you're certainly welcome to the slides afterwards if you'd like. So let's talk about the prepayment. So prepayments actually, although the concept is simple, there actually are a lot of factors that go into how do you manage a prepayment. Some of the factors are related to there's the prepayment, but then there's how do you show the customer what the prepayment is being applied to as far as the hours that are being delivered. And then there's also the situation where as an OpenAir system, although it can do invoicing, not every customer uses the invoicing. So how do you track a prepayment in OpenAir when you're not doing the invoicing part of it? And then finally, deposits in general, which can be thought of as a term of prepayment, but it's more of a how you can use that in more than just for prepayment of hours, but prepayment of anything in the system. So really the first example I have on the prepayments is the invoice is being generated in OpenAir. So we're starting with the fact that we have a prepayment with the customer, and the prepayment is for a certain number of hours. So we are generating the invoice in the system, and that alone, many of you are already jumping to the conclusion, which is a correct conclusion, that, oh, I just create a fixed fee rule and I bill them up front. But the real rub related to the revenue recognition piece of this and the WIP and deferred reporting is, well, how do I earn that revenue as I'm actually delivering the hours? And to earn the revenue as you're delivering the hours, you actually also have to consider, is the customer also seeing the hours on some kind of regular report or perhaps an hourly invoice? Okay. So I've got sort of 3 examples here where, as far as the hours that are being delivered to use those prepayments, are you sending an invoice to a customer that only show the hours that have been burned? Are you showing them the hours plus the value of the hours? Or are you showing them the hours only after they've used the prepayment? And all of those factor into how do you set up the different rule scenarios and configuration of OpenAir. So if we take the first example is you're basically showing hours to the customer. And what I mean by this is you're showing the hours that you're burning, but the rate is 0. So you're showing them, hey, I burned 15 hours of your 80-hour prepay, and by the way, the value is 0 because you've already prepaid it, so therefore the balance on the invoice shows the 15 hours, but it shows a balance of 0. Now in this setup, what you have to do for the invoicing piece of it is you have to set up the fixed fee rule for the prepaid. That goes without saying. But then you set up 2 time billing rules, one that's counting down the hours of the 0 rate, and then the second one that, once you hit your cap of how much they prepaid, it starts billing out at the normal rate. You have 2 time billing rules. And many of you probably have this already set up in your environment. And the benefits of this are, from an invoicing perspective, you're able to have all the charges appear in the open or build charge stage, and you don't have to duplicate any billing, and all the financial analysis report that's available in the system is there's no impact to it. Now to flip that around and say you want to take revenue on it, revenue recognition would actually be done directly from the timesheets because you need to actually recognize the value of every hour. And even though you bill the hour at $0, that's not a $0 revenue amount. There's actually a money amount that's associated with that hour because it's prepaid. So what you end up having to do is you end up having to insert another time billing rule smack dab in the middle of your rule set, and it's actually the very first rule, and you can make this inactive. So it's not actually generating billing, but it's tied to a revenue rule called time project billing rule. And what happens then is as timesheets are approved, you're taking the revenue directly from that timesheet. Okay. Now, how does that impact your WIP and deferred revenue? Now, if you're invoicing in advance, you have deferred revenue. And as you're taking the revenue based on the hours delivered, you're basically deducting from that deferred revenue balance. So you just have a deferred balance until the prepaid is completed. So there's the only risk, or not really a risk, but the only time that you would get in a WIP situation in here is once you've burned through all the prepayment, now you're actually recognizing revenue as you're delivering it. You're billing it to the customer at a value, you're recognizing it at a value. And when you're dealing with the time project billing rule recognition approach, it takes revenue directly off of timesheets, so it doesn't have an invoicing dependency. So there is a potential that you could be in a WIP situation if you happen to take revenue before you invoice it to the customer. Now, a variation of this is if the customer, you want to be able to invoice the customer and show them, hey, by the way, here's 15 hours, and here's the value of the 15 hours, $200 an hour. In that situation, it looks like you're double invoicing the customer, but what you do is you actually apply a retainer or a payment to that invoice, so the net balance on that invoice is 0. So what you're doing is you're creating the fixed fee to do the upfront billing. You're doing a time billing rule to bill all the hours as if you hadn't prepaid anything, but you're also using the retainer functionality of OpenAir to track the fact that they've already given you money. So you're going to apply that money as a drawdown to the balance of your retainer, and then therefore the invoice itself would have a balance of 0. So the customer does not owe you any more money. They already prepaid. Okay. Now in this situation, you do have the potential to have double billing on the surface. And what happens here is that if you upfront bill the fixed fee amount and then you also bill the time, that's double. So what you end up doing is you end up using charge stages in OpenAir, and you set up a new charge stage so that the fixed fee, the upfront piece of it, goes into a charge stage that A, gets excluded from the financial analysis, and B, is available to do filtering. So now you can create some custom calculations and do project accounting reports by filtering out the fixed fee or filtering it in depending on the scenario when you need to see the data. From a revenue perspective, because every hour is being invoiced as the full of value, you can actually use the as-billed rule. So now you have a tie right to the invoicing activity, and you're just going to focus on the hourly charges. So you're going to ignore that upfront prepaid charge stage. You're just going to focus on what was billed directly to the customer. You also could use the time project billing rule as well, because it just uses the approval from the timesheets directly. If you do use the as-billed rule for revenue recognition, you actually will be in a deferred revenue situation until you've used up the prepayment. And after that, it's going to net to zero, because if you bill it, you invoice it, or if you invoice it, you recognize it. And then you have the same potential for a WIP balance from a time project billing if you happen to finish using up the prepayment, but then you potentially take revenue before you invoice the timesheet data. Now the third example is related to the customer only starts seeing invoices once the prepayment is used up. Okay, so now you're not sending informational invoices, you're sending invoices that actually always have some kind of balance that needs to be paid. So this setup is a little bit of a reverse from the previous one. So here we want to definitely invoice the fixed fee amount. The fixed fee amount is for the prepaid. But then we want to still set up a time billing rule with a $0 rate, because we need to be able to count down that time billing rule. Okay, and ultimately this could actually also have a value, but we want to be able to count down until it gets to the prepayment amount, and after that it falls to a second time billing rule, which then allows you to start invoicing the customer. But that first time billing rule that's doing the countdown of the prepaid hours, that's going into a different charge stage. So right away you can see that there's a big decision that needs to be made on what does the customer see from an invoicing perspective and versus the charge stage setup that you have in place. So as the countdown hours are being burned, they're going into a separate charge stage. That charge stage actually can help drive revenue recognition. So a similar situation here where you can have a time project billing rule that pulls directly off of timesheets, and you're doing your upfront billing, plus the invoices are coming out for additional hours billing, and all of your prepaid hours that you're working are going into a charge stage for reporting purposes and countdown purposes. From a WIP perspective and a deferred revenue perspective, again, you'll have deferred revenue until the prepayment is earned. And the customer may not see any invoices, but from a revenue recognition as a company, you're going to see deferred revenue until all that prepayment is burned up. And then if you start doing your revenue recognition directly from timesheets, it's going to be a repeated statement throughout the rest of these scenarios. Anytime you do revenue directly from timesheets, where there's no dependency on invoicing, you do have a potential for getting a WIP report. Now, there's another scenario where the prepayments are not actually invoiced in OpenAir. I've seen some customers do this where it's being handled directly by accounting. And so the OpenAir system is really just doing the pro forma invoices based on the work being delivered. So in this case, we're not doing a fixed fee rule. We're only keeping track of the fact that we're doing T&M. And in this scenario, that you set up a time billing rule, and then you set up your revenue rule as billed or time project billing, as if it was a normal T&M without considering prepaid. The challenge with this, though, is you don't really know which project is prepaid and which project is not prepaid. So therefore, the reporting of deferred revenue and WIP is not necessarily reliable because we don't understand the fact that we've actually prepaid this work. So it will look like it's always in a, it could potentially be in a WIP situation, or it could potentially just be a net zero, there's no deferred, there's no WIP, simply because the system doesn't know anything about the prepayment invoice. And finally, in this sort of prepayment scenario, we talk about deposits. So the deposits are a term that I've heard customers use not necessarily as a prepayment, but it's basically money that can be applied to anything. So it's not a prepayment of hours specifically, but it's just a down payment or a hold to be able to apply potentially to invoices depending on what your contract terms and negotiations are with the customer. Now the invoicing setup for this is it's a deposit, so it typically is a fixed fee rule for the deposit. And then from that point, you could do additional rules, time billing, expense billing, fixed fee rules, whatever the situation is that drives your billing for the project. But that deposit fixed fee rule is going to put that deposit into a different charge stage. So now we're dealing with another charge stage because we have the situation where you're invoicing them up front, and then you're doing some additional invoices, and then you can apply the fact that they've paid a deposit, so you can apply that payment, and therefore you're using the retainer functionality again. So you have a deposit charge stage typically, and the revenue is not driven based on that deposit charge stage. From a revenue recognition perspective, depending on, again, how your revenue policies are, you could be doing an as-billed rule, ignoring your deposit because you can't take that as revenue. You could be using a time project billing rule. You could be using a % complete or an incurred versus forecast % complete rule. Either of those will basically allow you to earn revenue. So now, because the way the rules are set up, depending on how much of a deposit you've had, you could be in a deferred or a WIP balance simply based on what's been invoiced already versus what's been earned from a revenue perspective. And you'll see this also come up in a % complete model. Now another interesting scenario is managed services. So that was all prepayments and deposits for the customer. You're doing something upfront essentially. In a managed services situation, you're essentially committing to the customer that they're going to pay some kind of like maybe a monthly or a quarterly retainer, and the value of that retainer is X number of hours per month or X number of hours per quarter, for example. And the arrangement could be if you burn through all those hours, then the hours over that are at a certain cost or a certain bill rate. But if you don't burn all those hours, you forfeit the use of those hours. There's no carryover or rollover. I've seen that kind of contract before. And OpenAir actually can handle this very nicely. So what happens here is you build your fixed fee rule, and the fixed fee rule is what is actually going to do the invoicing, the monthly retainer amount. You also do a time billing rule for the $0 rate card. This is very similar to the prepayment of hours. But you use the time period cap feature that says every month I can go up to 20 hours. And then you create a spillover rule that takes the rate card and allows you to bill the services out as you reach or exceed the cap. But if you don't hit the cap, you're still billing the fixed amount to the customer. Now the $0 rate items can go into a separate charge, so at least you can charge stage, so you can still see that information, but you're not going to invoice the customer those $0 charges. So that's nice to kind of put that to the side and keep that out of the way with the charge stage. But the key for this type of setup is that you use the time period cap on the billing rule to be able to sort of reset the counter every period. Now from a revenue perspective, you can actually do straight as billed because you can recognize the revenue based on the fixed amount that's been invoiced, and you can recognize the revenue based on any overage hours. And heck, you can even recognize the $0 ones because it's $0, but you can just use a straight as billed rule, and the WIP and deferred should always be 0 because if you're billing it, you're recognizing the revenue in all cases. And even a further variation of this is if you've made an arrangement with a customer where you're letting them, you're agreeing with them that they're going to pay a fixed amount every month. They just want to understand and control their budget. And so you have come to an agreement that you may burn more or less X number of hours a month, let's say 20 hours a month. And some months may be more and some months may be less, but they want to have control and straight line. I expect to pay $5,000 a month for at least 11 months. And what you can do then is basically you're invoicing them a fixed amount, and then the final invoice of the contract is where you do the true up. So you invoice it so that they have a sort of control over their budget. So you set up a fixed fee rule, a date on rule, and you repeat it for whatever periods you have. And then you also set up a time billing rule, but the time billing rule is sort of billing the time behind the scenes, but it's never actually going onto an invoice. It's going into basically a ghost charge stage. And that allows you to basically keep track of what you've billed to the customer, what you should have billed to the customer, but the customer has agreed to a fixed payment for a certain period of time. And that ghost charge stage, you have to make sure that you set that charge date up, you exclude it from financial analysis because you don't want to duplicate information. You also exclude it for invoicing because you want to avoid invoicing twice to the customer. But what that allows you to do then is set up a revenue rule that says just recognize the revenue based on the ghost charges. So I'm recognizing what I've delivered. The customer is only getting invoiced the fixed amount. The final challenge to all of this is before you generate that last invoice is a true up. And this is where the WIP and deferred balance kind of helps out. Throughout the life of that type of contract, you will be potentially in either WIP or deferred balances, or net to zero if you're lucky, but it's typically you may be in a deferred situation because you didn't work as many hours that month, or you might be in a WIP situation because you've worked too many hours and the customer hasn't paid for all those hours yet. At the end of the project, you can take that WIP and deferred balance and factor that into what's the final invoice look like for the customer, because we've actually delivered maybe 50 more hours than what we agreed upon, so we have to bill them the rest of the contract. Or we've taken all the revenue, so we just take that last fixed payment and we're done with the contract. So this is an interesting one because this one is where the WIP and deferred really provides benefit because you can see where you're at in relation to the agreement on the fixed billing versus the earning of the revenue on an hourly basis. The last couple we have is the annual subscription. So annual subscription is more like licensing, where you license something for a year for a contract and you bill it up front. So it's $120,000 to license something for the year. You can't actually take that typically as revenue up front. You can't take $120,000 as revenue. You have to earn it because they're basically using the software or using your service throughout the year. So you amortize that over each month of the contract, so you take $10,000 a month. In this situation, the setup is actually pretty straightforward. You can set up a fixed fee rule up front to do the invoicing, and then you set up a fixed fee rule on date for the revenue, but you repeat the revenue rule every month for the contract or every quarter for the contract, depending on your revenue policy. And then as you're running reports, you end up seeing your deferred revenue in OpenAir. Deferred revenue shows up month after month as you continue to recognize another chunk, another chunk, another chunk, until you've recognized the whole item at the end of the contract. Now the fixed fee billing, this is the one where we have to kind of rely on the percent complete. And here we're basically doing the fixed fee billing with fixed fee rules. They can be milestone rules, they can be upfront and at finish, they can be periodic, whatever's been agreed upon from a payment schedule. And then the revenue recognition is going to be typically your percent complete or your incurred versus forecast. So you're earning it as you go, and you could be in a WIP or deferred situation based on percentage of work complete versus what you've invoiced to the customer. So the timing is really when you invoice to the customer versus the revenue or percent complete revenue of the project will identify whether you're in a WIP or deferred balance situation. Now, if all of that wasn't enough, there's a whole feature called revenue containers in OpenAir. So there's billing and revenue rules in the system. Then you can run reports to get WIP and deferred. But there's a revenue container function that basically works kind of like an invoice, where you have a container, and that container actually includes all the revenue transactions, and on top of that keeps track of how much you should have deferred or accrued based on any given action as the container is created. So the containers are sort of point in time It says, okay, so here's how much I've taken already, here's how much I've invoiced, here's what I should accrue, here's what I should be deferring from a situation here. And it does have a whole review and approval process. It's very similar to invoicing. So this is the one feature that allows you to have an approval process for revenue recognition. Otherwise, you're just giving permission to somebody to run rules and generate transactions. Now the revenue container feature, when you turn it on, it actually pushes all of your revenue from inside your project out to the invoices module. So now you have these revenue tabs in the system. And this is where you can look up your revenue transactions and your revenue containers, which analogously are like charges and invoices, the two different tabs. Now, revenue containers can be quite tricky to understand, but the functionality is built so that it does a lot of things for you. It's really more understanding what the feature is doing versus having to take a lot of action yourself. So the process is basically you run rules to create the transactions, or you can turn on this one-click feature that creates the revenue container and runs the rules for you. And as you create the container itself does all of the math and all of the quote-unquote journal entries, which are not official journal entries because OpenAir is not an accounting system. But it does all of the transaction migration to figure out how much did you have before you created the container for revenue, how much did you recognize at the end of the container, and what are the transactional changes that have happened because you did a container. How much have you accrued, how much have you deferred in the system. And it gives you basically a little report that you can look at. And then you can submit that container for review and approval and make modifications to revenue transactions and such along the way. So it's very similar to invoicing if you think about it, but it focuses on revenue. So here's an example to kind of explain what a revenue container does, and then I have an example of just what a revenue container report looks like. So let's talk about a milestone invoicing contract. At the start of the project, we've delivered some of the project, but we haven't done any invoicing. We've completed 25% of the project, which happens, and it's against the rule that the percent complete rule of $10,000. So 25% of a $10,000 contract. It's 25% of the project is done, and the percent complete rule computes that we get to recognize $10,000. So when I go to do my revenue, I actually, even though I haven't done any invoicing, I actually can use the revenue containers. It'll generate a revenue transaction for $10,000, and it'll create a container that shows that I can accrue $10,000, even though I haven't done any invoicing. So I have earned the revenue, but it's an accrual because I haven't actually done any invoicing in the system. Then I can submit the container, of course, to be approved. And then I get ready to do invoicing. So now I've decided that I need to invoice the customer, and I'm going to invoice the customer for $25,000. So if you're thinking in terms of WIP and deferred revenue, at this point, if I invoice for $25,000 and I've only recognized $10,000, then I'm in a deferred revenue situation of $15,000. But what the revenue container does is that once I've generated that $25,000 invoice, I can create another revenue container. And that another revenue container will run the revenue recognition rules, but you may not actually have delivered any more work, so there's no additional revenue to take. What the container will actually do, though, is it will create deferred and accrual transactions. So even though we've accrued $10,000 from before, now it's going to identify that we are still in a $10,000 accrual situation and a $15,000 deferral situation. And so the container keeps track of how much we've recognized versus how much we've invoiced, and reflects that in the accrual and deferred revenue transaction amounts. So the next slide shows you just an example of what a revenue container looks like. So you can see like the balance summary. The numbers here don't match with the previous example. I'm just kind of grabbed an example to show you, but you can see here how it shows you the detail of what's in this container, what the balance was before the container, what the balance is after the container, and what happened in this container. So Did revenue get posted versus accrued? Did revenue get deferred? So in that previous situation, that $10,000 accrual would turn into a posted revenue amount, and then $15,000 would show up in deferred, so that we would see at the balance at the end that we would have posted $10,000 in recognized revenue, and we would have $15,000 in deferred. So it's a nice feature. There is a lot behind the scenes on it, and it's something that, if you're looking for some kind of revenue approval process, it's something to consider, especially if you also need to keep track of the accrual and deferrals every period as you're doing your revenue recognition. So as we wrap up, basically the WIP and deferred revenue management sometimes is, from a reporting perspective, OpenAir can calculate all of that based on what you've recognized for revenue and you've done the invoicing. But the setup of the rules and the configuration of OpenAir in many times can be driven by the way that you need to see the invoices. Why customers need to see the invoices. They need to see the hours. They need to see the value of the hours. They don't need to see the hours. A lot of that factors into the configuration of OpenAir. Make sure you consider the impact on reporting, especially if you're in those situations where you're doing invoicing and you're doing billing rules to generate revenue, but it looks like you're double billing. Those are the situations where you need to set up custom calculations so that you're only counting the invoicing once. And we need to be able to use some configurations to ensure that the financial analysis report is kept whole. And finally, make sure you check policies for your invoice dependencies. So how are you recognizing the revenue will drive also how you need to set up the billing rules in the system. So there's internal dependencies, and then there's external and customer visibility dependencies that really can drive the way that you set up the rules and the way that you set up charge stages in the system.